Hello, good afternoon and welcome to MF Corner on CNBC TV 18. I'm Vinny Motiwala, and today what we're going to be discussing is we're going to be putting the spotlight on mutual fund investments for non-resident Indians. What are the rules for them if they were to open an account vis-a-vis an Indian resident, right? Like normally we open. What are the rules? What are the taxations that come into play for them? To discuss all of that, we're joined by Mrin Agarwal, financial educator and director at FinSafe India, as well as Joydeep Sen, corporate trainer and author. Mrin, as well as Joydeep, good afternoon and thank you so much for joining us on the show. Let's get started by talking about how do NRIs actually start when it comes to account opening for their mutual fund investments. Are there some provisions or laws they need to actually comply with when they actually get started with? Mrin, let's get started with you. Good afternoon.
So essentially, yes, there are some rules. So essentially, when NRIs invest, first and foremost, either they need to invest from an NRE account or from a NRO account, right? So that is the first and the most important thing. And the difference between the NRE and NRO is all about repatriation. So if they're investing from the NRE account, then of course it'll be on a repatriable basis. But if you're doing it from NRO, then the repatriation, direct repatriation is not allowed. Now, of course, they have to undergo a KYC, and the KYC has to be done when the individual is in India. And this is especially true for NRIs from US and Canada. So the US and Canada NRIs have slightly higher set of procedures to follow, and that's because of the rules and regulations in those countries. But yes, I mean, the first thing is that you have to be in India to set up the KYC. You need an Indian number where you can get the OTP. And the other thing is, of course, you have to make investments in rupees, and the investment needs to come either from a NRE or a NRO.
Okay. Joydeep, good afternoon. Anything that you would like to add on that front, as well as, just give us a highlight in terms of the taxation also that comes into applicability for NRIs. Does it differ a lot from what we or residents of India actually face?
Sure. Thanks, Vinay. So I will talk about it broadly.
Yeah.
Vinay already covered about the process part. So broadly, there is no legal hassle. There is no FEMA issue. FEMA is in Foreign Exchange Management Act. So it is pretty much seamless as long as you have the documentation and everything, KYC, everything is clear. Now coming to the taxation part, the guideline is for an NRI, income earned in India has to be put to tax in India, and tax has to be paid as per Indian tax rate, Indian tax laws. Now, whatever tax you have paid here, you can get the credit in your country. You're in a country, so it could be your country of residence. There's a concept called country of tax residence. Could be same, could be different. As an example, if you stay in, say, UAE or Singapore, you may or may not be a tax resident of UAE or Singapore. So whatever tax you pay in India, you get the benefit adjustment for that in your country of tax residence. Now, this is a function of DTAA, that is Double Tax Avoidance Agreement. But fortunately, we have this DTAA with most countries, or rather most reasonable countries. On the taxation rate, it's broadly similar. There are very fine marginal differences. An example, dividend. For us residents, dividend is taxable in our hands at our marginal slab rate. Now, for NRIs, how it works is the lower slab. As an example, in the new tax regime, up to 3 lakh is exempt. So in that 3 lakh, NRIs don't get the exemption, we get that. So depending on the amount, if 20% is the flat rate, dividends get taxed at 20% flat rate. Now coming to capital, as an example, equity taxation more than 1 year, that 1.25 lakh is there.
Yeah.
So for us, we get 1.25 lakh equity long term plus up to 3 lakh in a new tax regime at the bottom slab. For NRIs, they don't get that. They get 1.25 lakhs only. TDS rates marginally higher. But net doesn't matter because for HNIs, all this little bit here and doesn't matter. So broadly, tax rates are similar, and you get the benefit adjustment in your country of tax residence.
Okay. Mrin as well as Joydeep, do stay on with us. We're going to take a quick commercial break and come back as well. Welcome back to MF Corner on CNBC TV 18. While Joydeep was right now talking about, the taxation part, but are there any other repatriation rules that come into play, especially when it comes to dividend they earn on mutual funds and the principal investment? Also, are there any different implications for NRI investors in Canada and US, or is it the same across?
Right. So as far as dividends are concerned or the redemption proceeds are concerned, first and foremost, all redemption proceeds, as Joydeep explained, there would be a tax deduction at source. So the redemption proceeds or the redemption amount post the payment of the TDS or the deduction of the TDS and the dividends will be deposited in rupee only in the account from where the investment was made. So if it was made from the NRE account, it comes into NRE. If it's come from NRO, it will go into NRO, right? Now, the credit that is done for dividend or redemption is always done in rupees. And so for example, in the NRE account where the amount is allowed to be repatriated, this amount, the repatriation is not the responsibility of the mutual fund, right? So the mutual fund will only put the proceeds into the bank account, and then from there on, the investor basically has to do the repatriation. So I think that's one thing to keep in mind, that the mutual fund is not responsible for it. And as far as US citizens or persons from US and Canada are concerned, the investments, mutual fund investments, fall into something known as PFIC, which is passive foreign investment company. So what happens in this case is that the unrealized gains that the investor has in a year, which is from January to December, since that's what the US financial year is taxed as ordinary income for them. So again, I'd like to reiterate, it's unrealized gains that are going to be taxed as ordinary income. And these gains cannot be offset against any unrealized losses, and they can't be carried forward as well. So I think, from a US person's perspective, the tax laws, I mean, their country tax laws are really not favorable for mutual fund investing in India.
Absolutely. Joydeep, anything that you would like to add on that front? And also, I want to understand, is there any number of, maybe a restriction in terms of number of how much of SIP contribution can actually come in from NRIs currently? And how big are they a part of this retail contribution in mutual funds right now?
Sure. So on the first bit, Mrin explained very lucidly. Just to add one point, in US and Canada, they have all this FATCA and all these things. FATCA is in Foreign Account Tax Compliance Act, which places additional burden on the fund house and on the investor as well. So depending on the AMC's business call, how much the business they see or do not see from NRIs based in US or Canada. So some AMCs in India don't accept money from NRIs based at US or Canada. So typically the foreign ones or foreign-oriented ones don't accept. The Indian ones or the Indian-oriented ones, they do accept money from NRIs based at US and Canada, subject to documentation, declaration, and that kind of thing. On the second part, I will give you a broad number. The ballpark is 4% of the overall pie. The source is AMFI annual report as on March 25. So as on that date, approximately 4% of the pie was NRI contribution of the holding of the AUM. Now, since you asked SIP or retail, so the ballpark is 63%. If you do the math, 4 by 63, so approximately 6.3% is held by NRIs in the overall retail or individual kind of mutual fund pie. So to look at it broadly, while NRIs are doing well and they are investing in India, Indians also are doing well and investing in the overall pie is growing. And also if you look at it, the number of NRIs as a percentage is not as big. So the number is like 4% or 6.3% of the overall or retail share of the mutual fund AUM.
Okay, 4 to 6% is what their contribution currently comes in from NRI side as well. Mrin, what are the issues that are faced by NRIs when investing in mutual funds here as well?
So I think, as I mentioned, for US investors, the taxation aspect, but I think the other aspect really is the fact that you have to be, for US investors, you have to be physically present in India at the time of investment. And mainly, you're allowed only an offline investment. And of course, this whole fact of, for others, who are doing online, the OTP goes only to an India mobile number. And I think the bigger issue still remains that, we have too many funds, and it gets a little difficult for people to figure out which fund to basically put their money in. So I think these are some operational issues that are there.
Okay, some operational issues that are there, but yes, just in terms of changes that we've seen now, GIFT City is also coming, right? So do the changes in taxation with respect to GIFT City actually help NRIs? If yes, Joydeep, what are these and what are the benefits then that could come in from that side?
Sure. So I'll give you the framework first. So firstly, GIFT, even though it is in India, Gandhinagar, it is a foreign jurisdiction, even though it is part of India. And while laws of the land do apply there, for financial investments, like whatever products that are launched there, it is not the usual RBI or SEBI kind of regulation. It is the IFSCA, that is International Financial Services Center Authority. So it may be slightly different from the RBI or SEBI kind of regulations. So what it means is, as long as the manufacturer floats a product and it is approved by the IFSCA authorities, they can float that product. And yes, there are certain benefits also. So like we have so many funds, inbound and outbound products we have. So in the inbound products, what NRIs can invest, so we have a ticket size of 150,000 USD or 700,000 for if they have that AI accreditation kind of thing. And there are certain outbound funds as well. Now, this thing here is for inbound funds where NRIs can invest, resident Indians cannot invest there because as per RBI, that is kind of round tripping, so it is not allowed. Now, recently we had one outbound fund put by one Indian AMC, where the ticket size was as low as 5,000 USD, which is like very retail kind of 4.3 lakh rupees kind of amount. So maybe in the days to come, we will have similar products on the inbound leg as well. And if that happens, we will see more of NRI retail, not very retail, but retail kind of investments in India. And IFSCA Category 3, GIFT City Category 3 EIFs have certain tax advantages, like they are exempt as long as they're feeding into mutual funds in India. And it is more seamless for them, for NRIs, NAVs and USD, all those seamless things are there that helps NRIs at GIFT City.
Absolutely, a lot of benefits there. A quick one, Mirin, do you think that this will lead to more, retail funds or ETFs being launched in GIFT City now then?
I would think so, because I think we don't have the conversion cost issue. Also, I think there is no TDS and, all these issues are really not going to be there. The FEMA laws application and, the whole taxation, that's going to be very favorable because AIF is taxed at a fund level and not at an investor level, right? So I think, and you're saying the conversion cost. So I think these two, conversion cost and taxation itself, will be two great advantages that are there in the GIFT City, and hopefully, yes, we will see many more funds coming through.
Hopefully, let's watch out for that. But Amrin as well as Joydeep, thank you so much for joining in with us and giving us the details in terms of how NRIs can actually look at investing in mutual funds, the pros and cons coming in there as well. And viewers, thank you so much for tuning in as always. With that, we'll wind down this edition of Mutual Fund Corner. Thank you so much for tuning in. Up next, your closing bell.